And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk about everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we are focusing on, haven't had enough coffee yet, Joe.
I was about to say, struggling this morning.
Absolutely. Even my voice, I can feel it in my voice. Once you've been pre-approved or go under contract on that dream home, don't celebrate too hard. Know this, your pre-approval is not guaranteed. There are a handful of common mistakes that can blow it all up before you even get to the closing table. And the Joes, well, we want to make sure you don't make these mistakes by going over them with you today. But of course, before we get to all of that, a little coffee talk with the Joes this morning.
You know, I've got some things. This is kind of a coffee talk that's also educational. So I'm going to throw a spinner on there for you. So it actually goes with this show perfectly because we're talking about pre-approvals and what not to do and things like that, right?
Okay. All right.
So, you know, one thing I want to bring up is builders, lenders. You know, we have a bunch of things that we do for our clients. I do Zoom videos. I work on pre-approvals. We talk about budgeting. We go through a bunch of different things, right?
Mm-hmm.
And then all of a sudden, that real estate agent is taking them to look at a new build because maybe there's not a house that's fitting their needs in the market. That's not a new build. But what is your communication with your buyers that you pre-approve when they're going to look at new builds, Joe? Because I want to know what I'm missing or something, because I feel like there's a miss there of people not coming back and letting me review that loan estimate or their offer, and agents and buyers just trust the builder's lender has the best deal for them.
Which maybe they do, but maybe they don't.
Right.
And that's the thing, is that you as the trusted lender, and I understand because this is a beef that I have, and maybe we're both getting our venting this morning, but I don't care.
It's our show. We can do this.
if you're just tuning in, if you want to throw your beef on the table, feel free to put it in the comments below, because you know, to me, to have builders have an inside lender that basically monopolizes and shows all these pretty twinkly things to the buyer that comes in, you know, these low interest rates, when yet they're paying like 17 grand. They don't necessarily show that to them. We do, right? You know, is paying 17 grand and buying down the interest rate to that 4 point whatever, right? They don't show them that stuff, right?
And one of the things that I want buyers to understand this, and I want our listeners to understand this too, is that I'm not angry at the builder's lender. That's not my thing.
I think it's I don't think
it's a monopolizing. I agree with you, because they build it into the purchase price of the house to be able to give it back just to that one lender, but they keep it if it goes to anybody else. So I agree with that. But outside of that, you know, if I'm taking time to help somebody understand numbers, I'm taking time to, you know, out of the weekend to make sure that we go through everything and all that stuff. Why don't you trust me enough to send me that offer? Because, you know, that's completely understandable. You're going to, you know, do this. The problem that I'm coming back around to, and you know, I want comments. I want people to come at me. Real estate agents, come at me right now, because why? If you know you're making an offer with this builder's property, and it's a D.R. Horton or it's a Beazer home or it's a Lennar,
whatever. Why
call me back 4 times and rush to get a pre-approval when you know you're making an offer on one of those builders' houses that person's going to go through their lender?
Mm-hmm.
Go ahead and just have them go through that lender, because I'm that type of LO, and I know you are too, Joe, and I know I'm going off on a tangent, but I needed it today. I'm that lender that, you know what, Joe, if you show me an estimate that builder's lender, and D.R. Horton is one of the best at this, they can beat me on rate, They can beat me on fees because they own that lender, right? Yep. They don't care about making the money on that piece. They care about the purchase of the house, the sale of the home.
Yep.
Well, like other builders, they say they have their own lender, but it's a preferred lender. Mm-hmm. They are set up just like us, but they are getting a benefit from that purchase. So sometimes, but I have saved more clients money bringing to the table than what that concession was, because they try to eat it all up in points. Mm-hmm. And that lender is making more money on that deal than we make on ours at full compensation.
And I've noticed, just to cut in, I've noticed a couple of them that are VAs. They don't know what they're doing with VA loan.
Right.
They don't. So
this whole coffee talk was about trust us to guide you in the right direction. If I'm working a pre-approval, 100% of the time, I've got my client's best interest first. 100% of the time. Mm-hmm. Over my agent, over my referral partner, my commitment is to my client and not even to myself and my family. Because if somebody like DR Horton, or even if a preferred lender is beating me, let me see it so I can guide you, because I just spent 4 or 5 hours on different phone calls, different videos and everything else with you. There's trust there. I'm not going to guide you the wrong way. So thank you for my tangent coffee talk this morning. But we do have a good show, and I can't wait to get into this show today. Pre-approvals, and you said it exactly right, does not mean it's guaranteed approval. Mm-hmm. So, when we're doing this, Joe, and we talk about it, what is one of the things that you see when somebody gets pre-approved, they do, or that causes you stress when it comes to putting that loan together and getting it through underwriting?
So actually, I had this conversation with a client yesterday. We got them into underwriting Monday of last week, or Monday or Tuesday of last week. So just over a week, right?
Right.
And I get an email from them saying, and I'm not going to name names, by the way. I don't want to do that. We'll protect the innocent, so to speak, as they used to say on FBI shows in the old times. But it was Joe. Can you give me a more of an estimate, as far as what my cash to close is going to be, so that I know how much money my fiance and I have left over, because we want to start buying things.
Oh,
right? For the new house, right? For the new house. And what first went through my mind was, oh no, they're going to open up more credit, right?
Oh, okay. You went that way.
That's a big no-no, right? Once you're pre-approved or you're under contract, do not, folks, open up new credit. If there's furniture that you want, or there's a washer and dryer that you need for that new home, don't go to Home Depot and open up a new line of credit with a credit card, right? Because that is going to really screw things up.
So one thing to go with that: no new keys, no new credit. That's what I tell my clients. No new keys, no new credit. That means until you have those new keys in your hand, do not apply for another credit.
No new keys, no new credit.
No new keys, no new credit. And I like that saying. I wish people would listen to it more, and I wish I'd probably use it more. But I like that because you're right. It's not about we're pre-approved, we got to start buying for the house. And I get that mentality, because you don't want to go buy everything at one time. You don't want to have this big expense. So you think, okay, over the next 30 days, I can buy a couch, or I can buy a refrigerator, and I can do this and I can do that.
Right.
Where are you going to put this stuff if the loan doesn't go through?
Right.
And then now you have to deal with returns. So that's where I tell my clients, no new keys, no new credit. Don't apply for credit. Mm-hmm. That's the one big one is department stores at Christmas time, Joe.
Oh yes, please.
My mom taught me a long time ago. Hey, there's these discounts. My dad did the same. There's these discounts. The only department store card we had was Sears, and that's because my dad worked for him for 36 years. So, don't go out and keep getting new credit cards just to save 10, 15, 20% if you are going through a mortgage process.
And let's explain why, though.
Okay.
Right? Not just the don't do this, right? We don't, like our parents, don't do this, but they never explained the why behind it, right?
I got the why a lot.
Did you?
You didn't get the why? I told you so.
So all of our viewers, don't open new credit because I told you so.
Let's go into the why, because there's a bunch of different whys behind that people don't think about. So Joe, I'm gonna let you go with the first why, in your opinion, not to do it.
So I can think of two of them right off the bat. So I'll just choose one of them, right?
Okay.
When you do this, your debt to income ratio can blow up.
Yep.
Okay. It can, and can make it to where now you don't qualify for that mortgage.
That is one. Sometimes those can be offset. So that one there, I don't use that as the most important. And the reason I don't use that one as the most important, Joe, in my opinion, is because I could probably get a gift to pay off that debt if you opened it up. Most of the time you open up something like that, you have a smaller minimum payment,
like 25, $30 a month.
Right. So clients don't think in that fashion. They're like, oh, it's a $30 payment. I mean, I have enough, I make enough. So that one doesn't deter them as much as what happens if I have to pull new credit because you went out, you opened up a new debt. Now the underwriter wants to see that debt on the credit report. And if that underwriter conditions us to run a new credit report, then what happens if your FICO score drops? Because now you just opened up a new line. And if it's a revolving credit and you bought furniture on it, now that one is closer to your limit. That will kill my deal faster than just a payment.
Yes.
There's not a guideline that states you have to, but I know there are underwriters out there, especially depending on if you're doing a Govy loan or if you're doing a specialty convention loan, like the 1% down. I know you and I were talking about that before we got on here, and there is a program. It's 1% down. There's it's a good program. If you're interested, we'll put our emails up. You can reach out to us separately. But if that underwriter conditions me to where I have to pull new credit because they think it's a severity that could hurt your credit score, that could lose my approval. That could lose your pricing. That could also debt to income ratio, like you were saying. There's multiple different reasons just because of that one thing. So that's what I usually tell people is I don't want to have to pull credit again because we're already where we're at. So,
well, and what a lot of people don't know in regards to, towards the end of everything, that MERS check can be done at the end to see if they opened up any new credit.
Right.
And if they did, then the underwriter may, as you had said, may require us to re-pull a credit report. And if your credit came in at a 623 and you need a 620 for that 1% down program, and it just dropped it down to, a 602, well, you don't qualify for that conventional program anymore. You got to go FHA, and that just messed everything up.
Yep. No, I agree. The other part about that too is the underwriters, when they're doing this, it's at the very end of the process. You're talking about that no new debt mirrors whatever report they're pulling. That's at the very end. That's when they're getting ready to stamp final approval. That sometimes is 4 days, 5 days prior to a closing date. Well, if that pops up then, now we're delayed on a closing. So that's another reason why opening up a new debt, that, especially if you don't tell us or something like that, that's found out at the very end. And then all of a sudden we're scrambling. You're upset as a client because why didn't we know about this before? Well, because of this.
Right.
So that's also a good thing during the application process. I ask clients, hey, is there anything that's missing on these debts? Like I go through those debts with them because I've had it pop up. I just had this recently on a client I just put in. She bought a car in May. Well, when I did the soft pull, the car didn't show.
Oh.
And we didn't talk about it. Well, she had to buy a car because she got in an accident and hers got totaled. So she had to get a car. I get that.
Yeah.
But when I did the hard pull after we were making an offer on the contract, all of a sudden I see this $400 and some odd dollar payment pop up.
Wow.
Right.
That's
So
really...
it was between that time I did the soft pull and we made an offer that she had to buy a car. Well, I didn't know about it. So luckily I was able to save it and move it around and do different things. But, if that would have happened at the very end of our loan when we're supposed to close August 8th, and I find out July 31st, I'm scrambling and I don't know what to do.
especially that big of a payment.
Yeah. So that's why opening up new debt. And I know we're talking about credit cards and furniture stores, but car loans, I'm talking about any credit. Don't go do it. You know, one of the things that I hear from clients, and I don't know, Joe, if you've ever heard this, is, well, I thought getting a new car before the house shows up would help me because they're not worried about my debt to income ratio. I've heard that a lot, and I understand it, guys, but I will still tell you, go do that after you get the keys to the house, because it's still going to take over 30 days for that to show up on your credit anyways. So if you want to go buy a car, wait until you get into the house.
Yes.
You know, because you need to make sure your budget one can work. But that's the big one, is opening up those debts. And I'm glad we put that one on here first. But let's say, Joe, hey, I want to buy that couch. I don't have to open up credit because, you know, I've got funds in the bank.
Well, and I get that. However, those funds, right, may be being used for your down payment cash to close.
But Joe, my cash to close is only 17,000. I've got 24 in the bank.
I understand, but these are estimated numbers, and I want to make sure, especially if you make large purchases, right? We don't want to see large numbers going in and out of your account, because they can throw up a red flag.
Yep. That, and also, just because your cash to close says 17, we might need that 1 or 2 or 3 months of reserves to keep your approval, depending on the structure of your loan. There's different factors that go in there. So yes, we have you pre-approved based on these estimates. You go out, you make a large purchase, and all of a sudden your cash to, you know, your cash in your account or your assets go down $5,000. Well, that $5,000 could cause us to lose an approval in some cases. And so that's another thing, is before you're ever doing any big purchases, when you're pre-approved, please talk to your loan originator, because, you know, I've had some clients, they have, you know, $100,000 in an account over here, and that's the only account I'm using because, you know, my cash to close is low. And then they have their savings and their checking and other things. In those cases, I'm probably gonna be like, you're okay to go buy what, you know, this, but why are you buying that before you buy the house? It's kind of that conversation I have too. But you know, I get it. There's deals that need to be done, but talk to your originator before you go and make them, because even pulling that money out of your account can sway the way that we do things.
And I had at one time, this is a real example, that about a week before we closed on a loan, it was a purchase, that my client went out and bought a boat. I'm talking like, you know, an 85.
Hey, do you have that client's number? Do you have that client's number? Because I'm selling my boat, Joe. If anybody's watching and wants to buy a boat, I've got a Sea Ray on Lake Louisville. So
that's a good deal. We made good deal. Yeah.
But went out and bought a boat.
He did. Bought a boat, you know, put the down payment, because it was like an $85,000, $90,000 purchase. Right. And, you know, did the down payment. I can't remember what the monthly payment was, but I know it was like over $800 a month.
Oh, wow.
And you want to talk about screwing everything up. You know, his DTI just blew through the roof. Extended the closing for about 2 weeks. Yeah. I had scrambled to try to figure out how we could overcome this. Yeah. Right. So that, oh, wow. Yeah, that was unbelievable. And he thought he was doing it, you know, it was okay.
Have you ever gotten that phone call from your agent? Hey, Joe, I'm driving behind blah, 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 and they have brand new tags on this car in front of them. Did you know they bought a new car?
No, I haven't gotten that.
All of a sudden, I see that text. I called a client. Hey, can you tell me about the car you're driving right now and why you have brand new tags on? Hey, it's a company vehicle. Great, thank you. We're
okay, good. Yep. Good stuff.
I've had that call. But there's other things that you don't want to do during a pre-approval that are huge. And also through the whole buying process, you don't want to do this one. Joe, can you answer the question as to what that one is?
Do not change jobs. Do not.
Number one.
especially if you are going and had this, by the way, a realtor. Yes, realtors, if you're listening in, I guess forgive me if it seems like I'm stereotyping. I don't mean to do that. It was just this one particular realtor that she worked for a realty group and got approved for the construction loan. Right.
Right.
It was actually before they had the my vocabulary is gone. The one-time close.
Okay.
Right. With the land and the construction together, which is an awesome program, people. But so they had the construction loan. They got approved for that. During the construction, she switched positions from being, an assistant, if you will, in that brokerage to getting her license and becoming an actual realtor agent. So she went from being a W-2 to a self-employed 1099.
Yep.
Totally screwed things up.
So there are those companies that have done that to some of my clients, to where they're like, oh, we'll offer you a promotion, but now your pay structure is changing to where your commissions are considered 1099 income and your regular pay is this, but you were previously commissioned that was W-2. Right. Wipes out the type of income we can use. So changing your job or even changing your comp structure during it is a problem. Now there are times that you're not going to, have a say in it, right? If you work for a large company and they're like, oh, this is what's going into effect. Right. A lot of times that does not change because that doesn't show up, if it's already after you're pre-approved. But if that changed on you 5 months prior, make sure you share that with anybody that's pre-approving you, because they need to know, hey, my income stream and how I'm paid changed. Because if we're looking at year-end pay stubs and we don't see it on year-to-date, there's an income that might be able to be used or not, and we need to know about it. But taking a new job is huge. And if you are an employee that can work remote, right? Meaning that, like Joe and I, Joe works in Houston, I'm up in Dallas, sometimes I'm in Nebraska. I can work from anywhere to do my job and still be at NXT. Well, there are a lot of jobs out there that allow you to do that. But companies after COVID now, and we're now some years past it, are starting to make people come back into the office. So if you're one of those employees that you have to stay close to, don't switch jobs because you're trying to buy elsewhere until we figure out a game plan. Because that's another big one is, oh, I wanted to find a job because we're moving from, Austin to Waco, and it's a, hour-long drive to get there, and I'm going to switch jobs to here. Don't do that during the buying process. You need to either do that before or have like a true offer letter that states you're paid this amount and it needs to be in the same field that you were in. So there are ways around certain things when it's life circumstances, but do not just change jobs. No. It can kill deals, because what happens if your company is now paying you hourly where your previous company was paying you salary?
Right.
And they don't tell you it's an hourly pay. They say, oh, your salary is this, but then you get your paycheck and you see 40 hours, $40 an hour at 80 hours for every 2 weeks. But if that pay stub, because of training, showed 72 hours,
right,
now we're having to scramble to say, okay, how do we know you're full time? So those are things during the, after you get pre-approved. Don't start looking for another job right away. Let's get you in the house first before you make that decision too.
Especially if the house that you're buying, is in a different city or different state, because, you may be getting transferred or what have you. Right. You and I have both had clients before that they were moving from Texas to a different state, or maybe a different state into Texas. And if they work remotely, obviously we need letters, and that's verification that they are working remotely 100%, or in their new position, what is their new income? Is it still salary? Is it still hourly? Yada, yada. So yes.
And you bring up a good point there too, Joe, is if you are moving, let's say that you've used Joe in the past, the other Joe, not me. Let's say you've used Joe in the past, but now you're moving from Houston to moving to Oklahoma,
Okay.
don't just start looking for an LO in Oklahoma. Call back Joe. He's your trusted person. If Joe's not licensed in that state, he's going to know somebody within our company because we're nationwide. We have over 300 LOs, and we have a lot that are licensed just in our branch in different states. Go back to them, because then they can still be a trusted advisor and get you with somebody that they trust too. So I would say go back to them if you're ever having to be transferred, and get that worked out before you're moving and understand what your options are.
Very good. So we've covered 3 of the 5 that we wanted to talk about so far, as far as opening new credit accounts, big purchases, and not switching jobs. The next one I wanted to touch on, though, is probably a lot of people probably wouldn't think about this, but it's co-signing for someone.
I'm in that boat right now, right? If Hunter's now going to college, he's 19 years old. We established him some credit, which was great. But if he wanted to go and buy, a car, he would probably need a cosigner, because income.
What about college loans, Parent Plus loans?
Those two, that's a good one.
So you got to be thinking about these as you're going through, that you don't, because if you co-sign, a lot of people think, well, I just co-signed, that's still their liability. No, your name is on that. So you are liable, right? And that, even though they're making the payments, it's still going to show on your credit report as you're liable, and that's going to hit your debt to income ratio.
So Joe, how long do we have to show somebody has been making a payment on that co-signed debt? And I want to make sure you guys will define this. On the co-signed debt, meaning that, my son is on the loan and I'm on the loan as the co-signer. How long do we have to prove that my son has been making that payment before I can exclude it from my debt to income ratio?
12 months.
12 months, right?
And I have this with a client right now, right? That we have to actually wait until November, because in November will be the 12 months that we can prove he's been making the payments on the car.
Right. And it's not, and make sure you guys understand this. That payment needs to come out of their account, go directly to the car, and you do not need to be on that account with them, because then we have to show that none of your money has gone into that account. And let's all be honest. If you're a parent, you put money in your kid's account every once in a while. I don't care. I think my mom used to do that still up to, when I was at 40. She would just like, oh, here's $100. Oh, thanks for visiting us. Here's gas money. And I'm like, Mom, stop. I've got money. Right. Yeah. But, parents do that. So you got to make sure that, that is separated. So, do not co-sign during the pre-approval process. So just something put out there. But I think this next one is pretty huge too. And I know we're getting to the time, but this one we need to talk about is large deposits. Okay. If you get your tax refund, great. Get your tax refund, get it in your account. We can paper trail that back to your tax return. We can show where that deposit's coming in. But Joe, I deal with some, older clientele that, what do they have at home? They have a safe. What do they have in that safe? They have cash. And all of a sudden you get a $10,000 deposit into that savings account or that checking account, all cash. None of that can be used.
Nope, it cannot. It cannot. And we joke about people, having money under their mattress, right? Having cash under their mattress. And that's an old way of doing it, because that's what was safe, right? Because back in the Depression in the 1930s, banks were folding. So the safest place to put your money was under your mattress, right? So it is an old school of thinking from almost 100 years ago. But if you're doing that, I'm telling you, if you tell Joe or I that, hey, I've got 10 grand set aside for this, great. Where is it? Is it in an account? That's the next question Joe and I have for you. Where is that money? Because if it's under your mattress, we've got a problem.
Yeah. Right? And I'm not going to get into I'm not going to get in the fraudulent area, but there is a lot of gray areas on how you can make certain deposits. And things like that. So if you do have something like that, having that conversation at the very beginning during the pre-approval process, where are those funds coming from? Because I'm looking at your checking account and there's nothing in there. Oh, we have it here. Then that's a different conversation I'm having with my clients, because typical seasoning on large deposits and things like that is 60 days.
2 months.
You know, so we've got to make sure we know where we're at on those funds. You know, it doesn't mean that you can't use them completely, but we've got to figure out how we can use them in the proper way. So don't just start making deposits. And if you're a bartender or if you're a waitress and you're getting cash deposits,
right,
that's fine, because your regular deposits are always doing something with that. And that typically does not come up because you're a cash type business. You know, car lots, especially the smaller car lots that deal with cash a lot more. Again, that's a regular business kind of transaction. We're talking about if you're keeping it in your safe, you're keeping it in your safety deposit box, under the mattress, wherever, and all of a sudden you just start pouring it into your account again. Those are the ones that are going to cause us the most issues.
And if I remember correctly, Joe, please correct me if I'm wrong on this, because all these technical little things that we have to remember, the hundreds of thousands of different things we have to remember. I want to make sure I'm correct on this. So if there's a deposit that's more than 50% of your monthly income, that throws a red flag. Is it the 50% mark?
That is conventional loans only. So on conventional loans, it's a large deposit's anything that's 50% or higher. So if it's more than 50%, I always say 50% and higher, because I know underwriters, they'll be like, well, there's one penny here that, you know, took you over that 50%. So yes, anything under that. So if your income together is 10 grand a month, so any deposit $5,000 and less is not considered a large deposit. Is kind of what it is. So those, you know, if you made a cash deposit, but if the underwriter sees 4,900, you know, one day, 4,900 the next day, 4,900 the next day, they're going to start questioning, because they have to look out for anti-money laundering. And that's what cash deposits make them think. And so they have to start looking for some of those things. So there's a lot behind that also. And that's another reason you don't want to make large cash deposits, because if that starts raising that red flag and for some reason they think it might be anti-money laundering, then we're going down a whole nother avenue that I can't stop from them doing the research on, because that's by law, they have to.
Right.
And I'm not trying to scare people, but that's why we say don't make any large deposits, because we have to go through these anti-money laundering trainings every year. And every year we're like, okay, how does this happen? And then all of a sudden we get these deposits that are cash, and you're like, okay, now I can understand how this could happen.
Well, I'm glad we covered the why behind this, though. Right. Not just the don't do this because I said so, but the why behind it, because it can be red flagged as money laundering when you make those large deposits. Now, we're not saying, please keep in mind, we're not saying that you're laundering money. We're not. Okay. But let's face it, the lender does not know you, right? Doesn't know you like your family does. So they're just looking at the bottom line numbers, right? As far as the laws that they have to abide by, the guidelines that they have to abide by. So don't take it personal, right? We're not saying that you're laundering money. Just understand, don't make any large deposits. With all of these, the biggest thing I would say, all 5 of these that we've gone over today, before you do anything, talk to your lender, talk to Joe or I, right? Before you make any moves on this stuff. Just like my client did last night when he emailed me, because they want to go out and make, you know, some large purchases, right? Please do that with your lender. It's going to be a lot easier when you get to the closing table and actually be able to get to the closing table. So, well, that is all the time we have for today's show. Getting pre-approved is just the first step. Understand it's not guaranteed. Please avoid these 5 mistakes. They can make the difference between celebrating at the closing table or starting over. The bottom line, if you're not sure, ask your lender first. Reach out to the Joes if you have questions, or if you're looking to get pre-approved. Contact information, our emails are there below. Tune in next week as at our usual time, Wednesday, 9 a.m. Central, as next week we're going to discuss how to avoid making rookie mistakes when putting in an offer on your new home. Thank you to everyone who tuned in. Love your thumbs up. We didn't have any questions today, Joe. So
we didn't.
We did.
The participation was lacking today. So we need people to keep asking questions. Where's Josh? Josh's acronym of valued last week was awesome. So
we never found out what the D is.
It was in the comments. Like if you actually go to the Facebook, it did spell it all the way out. It just cut it off on our comments.
Did it? Oh, okay. Yeah. Oh, he gets a little long-winded. Well, if you know of anyone that is looking to buy a home, send them this podcast episode for them. Hopefully it's helpful to them. But do thank everyone for tuning in today. If you missed this or any of you want to catch up on some of our last episodes, go to our YouTube channel, The Mojo Show Real Estate Podcast on YouTube. And while you're there, be sure and hit the subscribe button because we are on a mission to get to 1,000 subscriptions. And every like, comment, and share helps us reach more home buyers just like you. So before we close things out, any last words or nuggets of wisdom for our listeners there, Joe?
The only thing is we are professionals in the mortgage industry. And our job is to make sure you're being guided right. Not everybody's going to feel the same way, but I know Joe and I. So if you ever reach out to us and you want to know, is there somebody that's giving you something better? Talk to us about it. Let us see that what you're being offered, because I'm going to guide you in the right direction. And I know Joe will too. That's why we work so well together. So we're here to answer questions. We're also here to make sure, you're getting into the best possible option of a loan for yourself, not always just the best rate. So, and we've had episodes on that too.
And we'll let you know that, right? If it's a better deal, we'll tell you, go take this, right?
Yep.
And that's it. So, well, I'm Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.
Mr.